All right, everyone. Welcome to Legacy Wednesdays, Financial Independence or Retire Early Through Real Estate. I want to welcome everyone who's joining the webinar here today. Look, we've got lots of people signed up, lots of people still coming in, but we don't like to waste anybody's time. Your time's valuable, my time's valuable. So we're going to jump right in. Today, we're going to give an update on the commercial real estate market and the real estate market in general. And we're going to talk about how you can find investment opportunities in today's market. But I really want to spend a lot of time talking about some of the headlines maybe you've been seeing and some of the market stuff, data we've been seeing. And while the headlines might not be the greatest headlines we've seen, I want to interpret it through our eyes as commercial real estate investors, why there are opportunities coming and how you can be ready to find these opportunities. So let's dive right in. Just a quick disclaimer, this webinar is for education purposes only and is obviously not legal advice, investment advice, or accounting advice. We always advise our investors, all of our webinar attendees, to consult with their real estate professional, their tax attorneys, to consult with anybody in their counsel to help them make investment decisions. You should always do that before you do anything. So please keep that in mind. What is FIRE? If you're not quite sure why you're here and what the heck FIRE is, financial independence, retire early is what FIRE stands for. And it's a big movement that we are excited to be a part of because we want to help our investors achieve financial independence, right? We want to help them achieve cash flow, want to help them achieve equity upside, and want to make sure we're putting their hard-earned money to work and providing them a great diversification vehicle outside of the equities market. So welcome to Legacy Wednesdays. We're excited you're here and that you're interested in FIRE. A real quick background on Headway Capital. If you don't know who we are a private investment firm based in Houston, Texas. We provide private investment offerings to busy professionals. Our goal is to help you build and protect your wealth. And we want to provide opportunities to give you the freedom to do what matters most. So real estate is a very, very hands-on asset class. If you own a large amount or even a small amount of residential houses, retail, triple net, apartments, whatever it may be, it's very unlikely if you were the sole owner and operator that is passive. It's likely a very active investment. So we provide passive private investment opportunities to our private list of investors so that you can do what matters most to you, whether that's more work, spending more time with your family, or going on vacation. We want to provide those opportunities to you by taking that burden off your shoulders so you can be diversified to commercial real estate by investing and partnering with us. We have lots of experience sourcing, vetting, and investing in alternatives. So I'll tell you a little bit about Sid and Anam. They're a great couple. Sid is the founder of CEO. His wife is Anam. She is a GI doctor by trade. Sid is full-time at Headway Capital. And Sid started investing in real estate not too long after the great financial crisis. He was able to accumulate a large amount of residential houses, accumulated 30 plus houses before he quickly realized that he needed to scale into the commercial space. In 2017, that's when he made the jump, left his W-2 job to focus on protecting his investors' capital and to focus on building the Headway brand in the portfolio. At the same time, 2017, 2018, that's when we launched Headway Properties, which is the vertical integrated arm of Headway Capital. So great upside when anytime you partner with Headway Capital in any of our multifamily apartment deals. We are the ones managing it. So when something goes great, it's on our shoulders. And when something goes bad, it's also on our shoulders. There's nobody to point the blame to except for ourselves. And that's something we're very passionate about. We're very passionate about operations. We're very passionate about providing a great work environment for all of the great partners and employees at Headway Properties, and also providing a great living experience. So Sid is full-time in that, and he's excited to continue to grow the portfolio. Anam is our director of business development. She spends a lot of her time helping us connect with new investors because Anam herself is very busy. She's a full-time GI, as I mentioned, and she has a lot of conversations with a lot of people in the healthcare field that have a lot of interest in investing in real estate, but they have no idea where to get started. So she's able to open those doors for us and is very passionate about educating people on the topic of commercial real estate investing. And then we've got me here. My name is Brian. I am the director of investor relations here at Headway Capital. I'm also very passionate about sharing the knowledge that I've accumulated over the years. I started investing in real estate in 2018. And like a lot of you maybe on this call, I was able to start by investing in single family houses. I thought buying rental real estate, buying an ugly house, fixing it up, putting a resident in it, and refinancing it and letting it cash flow was the way to prosperity. But I quickly found that I bought myself a job after accumulating a handful of houses and that I wasn't making the cash flow that I thought I was going to make make, because all the money I was putting back into the properties whenever the tenants left, or I would have a roof replacement, or an AC would go out, or a water heater would go out, and that $200, $300, $400 a month that I was saving on these residential properties was just disappearing. Right, so I would be making $3,000 to $5,000 a year per house, but it was going right back into keeping the house nice and rent ready, as we like to say. So I switched over to commercial real estate right before COVID, right around the time COVID was getting started, late 2019, early 2020. I worked at a boutique private equity firm here in the Houston area before transitioning over to Headway. And it's the director of investor relations now. So super excited to be here, and looking forward to meeting everybody after this call, hopefully. I want to talk a little bit about our track record before we dive right in. Just a little bit more about Headway. We have a little over 500 million of assets under management, which accumulates to over 3,000 units. And our target buy box, what we really look for are deals that can provide a 7 to 10% average target preferred return. We want to provide you monthly cash flow. So if we can do that, we don't touch anything that doesn't cash flow. It's one of our rules. So we want to provide that 7 to 10% monthly cash flow. That's really our target for monthly cash flow. And then at an annualized return, whenever the deal finally sells and it exits, most of our deals are 3 to 5 year holds. We want to provide 25 to 30% average annualized return. Our goal is to always double our investors' money over a 5-year hold at the bare minimum. So that's a 20% return. But if we can sell faster and get above that 2x multiple, we really want to try to touch that 25% plus return, so that you can we can all win together, and we can all make lots of money and be very excited about the real estate deals we're investing in. So let's dive right in. Let's talk about why you're here. I want to spend some time talking about finding investment opportunities in today's market. But before we find investment opportunities and we talk about how you can find passive investment opportunities in today's market, we have to talk about what's going on in today's market, right? We have to talk about more than just we're seeing in the headlines. I want to talk about some of the data and go through some of the charts, and to help give you a perspective on how we look at commercial real estate and why we are still bullish long-term about the investment opportunities that are, what I would argue, around the corner in the market. So let's dive right in. So today we're going to talk about the state of the real estate market. We're going to talk about how interest rates are impacting commercial real estate, and a little bit about residential real estate today as well. And then we're going to talk about how you can still find investment opportunities out there, passive investment opportunities out there, if you're looking in the right places. So let's dive right in. Let's talk about the state of the real estate market, right? Let's talk about what we all know. Writing's kind of on the wall. Elephant's already in the room. You probably see it. But the demand for commercial real estate loans is at 2008 levels, right? So that sounds like a bad thing. So as you've all probably seen in the headlines, or maybe you've heard, or maybe you're very connected to the market, the real estate market, there are not a lot of transactions happening, right? And it's all very obvious why that is happening. Starting in March of 2022, the Fed started raising interest rates, right? And that essentially crumbled our ability and investors' ability to generate loans that would produce any type of yield or any type of cash flow, right? So demand fell off a cliff. We weren't able to get the capital we needed from the lenders that put us in a position to actually provide returns to our investors, right? So demand for loans has fallen off of a cliff, right? So this is a very interesting chart. When you look at what happened coming out of COVID, you see that dip in 2020, and then you see the massive spike in 2000 coming out of 2020 all the way into 2021. And then now this chart's a little outdated. This is prior to we're in obviously going into quarter three here in 2023, but this chart doesn't have the most updated data. But just kind of seeing what was happening at the end of last year, real estate loans just essentially fell off a cliff. People weren't able to get deals done, which is why it's been hard to find investment opportunities, right? Let's also talk about rents, right? Rents are really important in our business. What have we kind of seen from the data? So you'll see this chart here. It's from Redfin, which provides a lot of residential data, but it's also very telling. Our markets, even though we're not in residential real estate, is very connected, right? Because what happens in the residential market often has an impact in the commercial real estate market, right? So you'll see that the typical U.S. asking rents are just shy of record high, right? So we have seen tremendous rent growth coming out of COVID. There were some markets. We're here in Houston. We had some 2021 was a double-digit year record for rent growth, and there were some markets like Phoenix, Arizona, for example, that just saw insane rent growth. There were some quarters and some in the years that just were unprecedented, right? So it feels like we've hit the top. It feels like we've hit the peak when it comes to rents in the market, and we're starting to see that slow, right? So you'll see the bottom half of this chart, the year-over-year change when it comes, and this is pretty accurate. It's from July data. You'll see the year-over-year change is now just 0.3%, right? So we're starting to see rent, I wouldn't say decline. Rents aren't going negative, but we're starting to see just rents stabilize. They're flattening out, right? And this is really, really important when we start talking about finding investment opportunities, because when you're looking at deals, you want to make sure that the rent growth is actually feasible. You want to make sure the rent growth is actually possible, right? So if you're looking at a deal and it says it has 12% rent growth, well, you need to ask a lot of questions, right? Knowing that rent growth is slowing down drastically, the question is how do you get to that? I'm not saying it's not possible, but you have to really be conservative and ask a lot of questions of any of your operating partners or your investment partners, right? So rent growth has drastically changed in the last 18 months. That correlates with supply and demand of real estate and the interest rates that we're seeing in the market. But the good news, just kind of silver lining here, is this again came out from Redfin, and this is actually from September 1st, so just a few days ago. That Redfin is reporting that September rate hikes increasingly unlikely after this week's job report. So if you're not connected to the job market, I don't have any slides here about the job market, but I would highly recommend that is something you stay very, very, very in tune with. The job market drastically impacts what the Fed's policy is, which drastically impacts what happens in the real estate market with interest rates, right? So last week, some data came out saying, I believe the number was 187,000 jobs were created for the prior month. While that sounds like an amazing amount, it's a massive drop off from month to month, going back just a month before that, and then even the month before that, right? So we're seeing massive deceleration in the job market, and we're starting to see an uptick in unemployment, although it be very small. I believe July's data was 3.4% in unemployment, and it bumped up to 3.8% for August. Doesn't sound like a massive change, but it's a huge change when it comes to the job market. Now, when the job market starts to soften and unemployment starts to creep up, and there are more part-time jobs than there are full-time jobs, which is exactly what's happening right now, that shows the Fed, that shows Jerome Powell, who's running the Fed, that what they're doing is working, right? They started raising interest rates in March of 2022, and they have to ask themselves, if I raise rates 25 basis points today, September of 2023, what type of impact is that going to have 3 months from now, 6 months from now, 12 months from now? Because these interest rate changes, they take time. We're just now starting to see deceleration over the last couple of months in inflation, and deceleration also in the economy growth, right? And we're starting to see job loss finally starting to pop its rear its ugly head, so to speak. And it took from March of 2022 to summer of 2023 to really start seeing the changes that the Fed made over a year ago, right? So they have to be very careful. And there's a very low percentage that they raise interest rates in September. Of course, it's always possible if some sort of data points them in the right direction. But the good news is they're not predicted to raise interest rates in September, which is good. I put this little funny slide on here, just kind of poking fun at it. This is Jerome Powell, and that's the housing market, because right now the housing market has just fallen off of a cliff, the residential housing market, right? So let's talk about what these interest rate changes have done to the real estate market. So how have interest rates impacted the real estate market? And again, this is all going to come to fruition, a full picture towards the end on how this can help you find passive investment opportunities, right? So it's important that you're educated before you make these decisions. So how are interest rates impacting real estate? This chart here by Redfin is really, really, really interesting. This chart shows year-over-year growth in investor purchases. Now, not consumers that are buying home, primary residence to live in, but investors. You'll see in Q2 of 2023, there was a negative 45% drop in investor purchases, right? So that shows you that not only can homeowners not move or buy a house because of the interest rates right now, but investors are also having a hard time making the numbers work as well. right? So a really interesting chart to kind of see what happened. It's also equally as interesting to see what happened in Q1 of 2022, where there was a 130 or 140% 130 or 140% increase in the investor purchases as well. So just again, just really interesting stuff that going on with this chart here. And how is this impacting apartments, right? How is this impacting the multifamily space? If you're here and you are on this webinar, you probably have an interest in commercial real estate. You probably have an interest in multifamily. You'll see here this chart, which is from Marcus and Millichap. And if you're not familiar with them, I highly recommend you go to their website. They have some great webinars, some great videos, some great data. It really helps you stay on tune with what's going on in the multifamily space or any asset class, really. U.S. apartment transaction activity has slipped in the last 12 months. So you'll see in this chart here, we've obviously got record-breaking transactions over, really 2021 all the way up to Q2 of 2022, Q1 of 2022 at the very end, March. So when they started raising interest rates, you kind of saw the peak here, and then you'd see things start to decline. This orange line is indicated of interest rates. And when the Fed started raising interest rates, that's when you'll begin to see they have an opposite correlation. Obviously, as interest rates go up, activity on the apartment side has really, really started to slip. But the good news about that is we are finally starting to see price recalibration in the multifamily space, and the buyer-seller expectation gap is shrinking. So what does this all mean? Well, coming out of 2021, buyers had a really hard time valuating properties because sellers thought their properties were worth, way more than they probably were, and they expected the moon. Anytime a seller was selling a property, it was selling for 5 to 10%, sometimes more, over what they thought it was going to be worth. Well, the buyer expectation gap was massive. I wanted to pay $10 million and the seller wanted $12 million or $13 million. There's just massive gaps between what the property was worth and what made sense to the investments and what the seller actually wanted. Well, the good news is the interest rate environment. And we saw the previous chart that had a massive deceleration in volume. It is starting to recalibrate price expectations to where the gap is actually shrinking, right? So buyers and sellers are actually getting closer and closer to being at a point where their valuations are actually, I'm not going to say equal, but closer. There's more room for negotiation, right? Again, just to use that example, if I think it's worth 10 million and they thought it was worth 12 or 13 million coming in out of COVID in 2021, well, maybe now it's 11 million, 10.5 million. It's a more realistic number that you can actually wrap your head around when it comes to trying to make the numbers work, trying to make the cash flow work, right? So this is great news that we've seen through Q2 of 2023. We're seeing a massive decrease in the expectation gap between the buyers and sellers. So this is great news. What this means is that we are right around the corner from deals actually making sense, to where you're actually underwriting the deals, you're penciling the deals, as we like to say in the industry, and there's actually cash flow. The deals actually make sense. The prices make sense. The cash flow makes sense. And the risk that you're taking for investing in these properties actually makes sense. So this is great news. Again, this is from Marcus and Millichap and data from CoStar as well. So since these rates have gone up, what's been happening to the deals that have been trading? So this is an interesting chart too, as well, to kind of show through Q2 of this year who's getting deals done, right? So you'll see, looking on the right side, in 2023 up into Q2 of this year, 64% of the deals that are trading are happening by private investors, and only 1% are happening by REITs, and 27% are by institutional equity. Why is this important? Who cares? Well, I will tell you, we are a private real estate firm. Headway Capital is a private real estate firm. We do not want to be competing with institutional equity, right? We also don't want to be competing with REITs, because these funds, they have different motivations, right? They're looking for something different than what we're looking for. We're looking for high cash flow and equity upside, and we want to be operators, right? They're looking for something different, right? So what that means is they are always willing to pay more. And when there's too many institutional buyers in the market and there's too many big funds in the market, that drives up prices, right? It makes it really hard for private firms such as Headway Capital to compete, because we're not going to overpay for a property just to say we won the deal, just to say we like, oh, here's an investment offering, even though we paid way too much for it. There's a saying in real estate that you make your money on the buy, and that's not 100% true, but it's definitely a big part of the equation. We want to pay the right price. We want to buy right, right? So in order to buy right, we want to compete with other private real estate firms that understand how to value properties to actually generate cash flow that the investors are happy with. We don't want to be competing with REITs. We don't want to be competing with institutional equity. So to see that the slice is getting thinner and that a large portion of the market is actually of the deals being done are actually being done by private real estate investment firms like Headway Capital. Well, that's good news. That means that the competition is fair. I can tell you, having been in the space now and through COVID, that the competition was not fair in 2021. Most of the properties that we were bidding on and that we were trying to win and present to our investors and invest in, they had 20, 30, 40 offers, which is insane, right? It's insane to think that a property that's worth 10, 20, 30 million dollars has 30 or 40 offers, right? When that happens, the seller is super happy and somebody is very likely to overpay, right? And a lot of those people that were overpaying at the time were institutional equity that were just they just wanted to get deals done because there was too much money in the market. There's too much capital floating around and they had to put that capital to work. So we want to deal with other private firms. So really interesting chart to see that right now, majority of the deals getting done are from private real estate firms. And the last couple of slides here I have on some data that are going to help you make investment decisions in today's market. Has to do with rent growth and kind of looking at markets and understanding that every market's different. And this is really important because real estate cannot be put all under one umbrella. I always think it's really funny when you talk to people who are not in real estate and they say, oh, the real estate market's going to crash. And I'm like, well, what does that mean? There's so many asset classes in real estate. The whole market is just not going to crash. Maybe particular assets will crash. And then maybe particular markets inside of that asset class will crash, right? Or drop in value, I should say. Crash is a strong word. So you have to understand that real estate is hyper local, right? Real estate is asset based and it's hyper local. You have to look at what's going on in different markets to make decisions on whether investment opportunities make sense, right? So I have this chart. This was pulled from Yardi Matrix, which is another resource that I would highly recommend you check out. Just Google Yardi Matrix data or Yardi Matrix news. You can find all kinds of interesting charts on what's going on in the market, both in multifamily and other asset classes. This is a chart up through July of 23, so it's only a couple months old. And you can see year over year rent growth as of July 2023, right? So you can see some markets down at the bottom, like San Francisco, beautiful place to visit. But we've all seen the headlines on some of the scary stuff happening politically and with the population there in San Francisco. Office buildings are vacant. People are leaving. A lot of people are frustrated with the politics there. So you're seeing rent decline there. And it's also a really expensive market. That doesn't help. Then you've got, Atlanta, which is historically a pretty strong market, seeing some rent declines as well. But then you got other markets, right? Like we're a Houston-based firm. And you'll see here, Houston is sitting right in the middle of the pack. It's still had some pretty healthy rent growth despite all the economic headwinds we're facing and the challenges we're facing today. Houston has seen 1.7% rent growth as of from January 1st to July of 23, and it has a 2.1% forecast rent growth for the end of the year. So there's still some opportunities to get there, but if not, Houston is still in a very strong position when it comes to rent growth. And part of the reason is if you look at the year over year job growth, this is really, really important. You don't want to invest in somewhere that doesn't have strong job growth or doesn't have a stable job market. You'll see Houston, again, this is where a lot of our assets are based and a lot of our opportunities are presented, has a 4.2% year over year job growth. Well, what a coincidence that strong job growth leads to healthy rent growth, right? So really important when you're looking at some of this data that you're looking at the job growth right now. Job growth doesn't always correlate to rent growth. You see some markets down there that are negative or close to it that also have job growth. But you definitely want to see strong rent growth and strong job growth anytime you make an investment decision, right? And then over here on the right-hand side, also from Yardi Matrix, I've got Houston versus the national rent growth. And it's interesting to see the dark blue line is the national line, and the light blue line is Houston. Houston's always been a little bit below the national rent growth line. It is a blue collar city, very industrial. We've got the Port of Houston. Obviously, we've got the oil and gas industry, and then the medical field. But you'll see that the rent growth has finally caught up with the national average as far as April of 2023. So again, real interesting data to see how Houston kind of correlates with the national averages. But long story short, when you're looking to invest and you're looking at today's market, and you're looking for investment opportunities in today's market, especially if you're looking at, let's say, multifamily, for example, apartment complexes, or if you're just, you're on here, you're just getting educated, and maybe you're interested in residential houses, you want to buy some rental houses, and that's okay too. Definitely make sure you're doing your homework on rent growth. And again, this is just Houston as a market, or whatever city you're looking at. Maybe you're looking at Columbus or Richmond or Miami or whatever it might be. Just make sure you're looking at the local market as well. Certain pockets might have negative rent growth or flat rent growth, or maybe even higher. You just really do your homework on the market. It's really important. And the last kind of slide here that I want to make sure I highlight is a lot of people are wondering, people aren't investing in real estate. Where is all their money going? And I think this is a really interesting chart. It shows here that as of today, $896 billion of cash has went into the money market funds during the Fed hiking cycle. So the Fed started hiking interest rates, as I mentioned, in March of 2022. And we've seen a massive, massive, massive influx into money market funds. Well, what the heck does that have to do with real estate? Well, there's a problem, and there's another chart on here I didn't put that I should have put, is we're seeing a massive decrease in bank loans and funds that are inside of bank accounts, because a lot of people are flocking and putting their money in money market funds and money market accounts, right? Well, that's not a good thing for the real estate space, because banks need to loan money. Right. So it's going to take some sort of correction for that to be corrected, and for money to flow out of the money market accounts and back into banks, because we need money at banks in order to make small loans. Now, we are buying large deals here at Headway. We're usually not borrowing money straight from a bank. We're usually using Fannie Mae or Freddie Mac type products to get our deals done. But thinking about the real estate market as a whole, thinking about residential housing, thinking about small commercial real estate, say loans under $10 million, we really need we need that capital to flow out of the money market accounts and back into bank accounts. And in order to do that, we just have to see a correction when it comes to these interest rates. So again, just really interesting to see how how real estate and how it's been hard to get deals done, and how it's been hard to have cash flow has impacted where investors put their capital. And it's just an interesting chart to see here. So how can, we went through quite a bit here, right? So we went through what's going on in the market. We went through investors, private investors being in the market. We talked about the price recalibration. So hopefully now you have a better picture of what's going on in the commercial real estate market. And the question is why do we think, how can you find good investments? And then why do we think there are investments right around the corner, right? Our opinion here at Headway Capital is that there are going to be some distressed assets that are going to be great buying opportunities here in the very near future. We talked about all the struggles that the market is seeing. We talked about the high interest rate environment. We talked about commercial transactions slowing down. We talked about the buyer-seller gap closing to where it's actually going to make sense to get deals done. What we didn't talk about is how there are going to be some motivated sellers. There's going to be some people who overpaid in 2021, which I kind of talked about a little bit, that are going to need to sell their deals, right? And it's going to actually make sense to invest in these deals. And the best time to invest is when other people are saying it's not. A lot of wealth gets created during recessions. If there's a recession, a lot of wealth gets created during downtimes. And a lot of wealth gets created when you actually buy these properties at a severe discount. So we've already seen prices correct in the commercial real estate space, as anywhere from 15 to 20% over the last 18 months since they started raising interest rates, sometimes higher in certain markets, sometimes lower. But if there's an opportunity to buy a great quality asset that produces cash flow day one, that actually has some opportunity to improve, why would you not invest in that asset, knowing that it's a long-term hold, knowing that there's a 3 to 4 to 5 year investment strategy? And as long as you're receiving that cash flow, as long as there's equity upside, as long as the property is underwritten in a conservative manner with the right type of loan product on it that doesn't over leverage the product, why would you not buy something when it's on a discount, right? How many people on this call wish they were buying real estate when it was, 30 to 50% off coming out of the great financial crisis in 2010, 2011, 2012. There were some phenomenal buying opportunities. We all wish we bought a bunch of apartments and multifamily and single family houses back in that day. Now, why didn't we? Well, it was the headlines, right? We were all scared. We saw what happened in 2008. A lot of people's savings got wiped out. A lot of their retirement got wiped out. And even though properties were 30 to 50% off, it was really hard to find banks to give you loans. And it was really hard to raise investor capital. Investors were very bearish. They were very nervous because of what they were reading on the headlines, right? Which is why one of my points here is I want to make sure you understand is you have to, and this is why we spent all this time talking about this, is you have to look at the data, right? You can't just read the headlines when you're scrolling through whatever your media outlet of choice is. And if it says real estate crash imminent, real estate crash coming, and you're just like, well, market's going to crash, not investing, right? Well, you could be missing out on a phenomenal buying opportunity if you just did a little bit more homework. And not only do you need to do homework and understand what the data is telling you, all the stuff that we talked about today, is you need to actually partner with somebody who actually understands how to leverage the data and how to use it to their advantage to find phenomenal investment opportunities. So how do you find those? You got to stay active, right? You got to stay active in what's going on. You can't just read the headlines. You got to look at the data. We're looking at all kinds of stuff every month. We're looking at rent growth. We're looking at cap rates. We're looking at the JOLTS report for jobs. We're looking at what's going on with U.S. savings. We're looking at credit cards. We're looking at the 10-year treasury. We're looking at the yield curve. We're looking at all kinds of stuff to see like, hey, what is the data telling us with what's going on in the market? And you must stay active. If you're just sitting on the sidelines, you're going to miss a prime buying opportunity or a prime investing opportunity to buy properties at a severe discount. And you're going to be very happy you bought a property at 20, 30% off in 3 years and 5 years when you sell it. Is it going to be challenging to get deals done today? Absolutely. It's going to be much harder. Investors are a little bit more nervous. Deals are a little bit harder to get done. But if you can get those deals done and you can invest, you're going to be very happy as long as you have a long-term outlook, which is what you should have if you're on this call. If you're investing in real estate, it's a long-term vehicle. We're not here to flip properties and get in and out in 3 or 6 months. We're here for long-term wealth accumulation. So you must stay active. The second thing you must do is you must find a private sponsor, a lot like Headway. You got to find some people to partner with, right? If you're new to commercial real estate investing, if you're new to passive investing, and maybe you only have a little bit of experience with residential housing or REITs, or you have no experience at all, you have to find an experienced partner that knows how to navigate these waters, that knows how to navigate recessions, if we have one, that knows how to navigate some of this financial turmoil, and also has a team in place to take advantage of these opportunities. These investments are hard. They're hard to manage and they're hard to execute. The business plan, they sound easy, but they're not, right? Just buy a property, fix it up and sell it. Well, that sounds much easier than it is. You got to have a team, right? Which is why, we have Headway Properties and we have a great advisory team in our court to make sure that we get these deals done. So find a private sponsor like Headway, and you want to be ready. You want to complete an application to invest or get to know that sponsor, right? Call them, get on a call with them, go out to lunch, do whatever you need to do to get to know that sponsor. Watch their videos like this one, read their blogs, get their philosophy, get their investing philosophy, and build that trust with them so that when an opportunity presents itself, you're ready to roll, right? Schedule that call with them, get to know them, find out what their track record is. Have they been through a recession before? If not, that's not necessarily a deal breaker, but how do they plan on navigating what's about to happen? Are they well capitalized, and do they have the team to make it happen, right? And then the goal is to really be ready to move quickly, right? You want to be ready to move quickly so that when somebody presents an opportunity to you, you want to be able to jump on it and say, like, you know what, this is a great deal. It's at a severe discount. There's a lot of meat on the bone. It's going to cash flow almost immediately, and I really like the sponsor and the business plan. I am ready to invest. So you can invest very quickly when these opportunities come up. So how do you quickly analyze one of these deals when they come up? When you get to know these sponsors and you find companies like Headway, a private investment firm to invest in, you just want to run them through what I like to call my 7-step filter to run all your deals through. You want to look at the target market. Is it in a great market? We already talked about that. You want to look at the location. Is it an A, B, or C class area? What risks are associated with that particular area? What asset class is it? Is it a multifamily deal? Is it a car wash, self-storage, industrial, hotel, triple net? There's so many asset classes. Is it one that you're actually interested in? We're very bullish on multifamily because of the need for housing and for the fact that homes are not as affordable as they used to be. And there's always going to be a need for quality, affordable housing in America. So we're bullish on value add workforce housing. Management, who's managing the asset post closing? Is it an experienced team? Who's the property manager? Is it a vertically integrated company like Headway Capital owns Headway Properties, or is it third party management? No right or wrong there, but you want to make sure the manager is experienced and you could trust them. What's the business plan? Is it feasible? We talked about rent growth. We talked about some of the data here today. If I'm telling you that rent growth in Houston is 1.7% and you see a 10% rent growth on my pro forma, well, that's a red flag that you need to ask questions about. Doesn't mean it's not possible, but you just definitely need to ask. 10 is probably aggressive. Maybe you see, a 2%, a 3%, or 4%. That kind of makes more sense, but something really aggressive, again, you need to ask questions. And then, look at some basic numbers, right? What are we paying for it? What's the price per unit? How much are we planning on selling it for? What's the entry cap rate? What's the exit cap rate? Is it realistic? But long story short, once you run it through your 7-step filter, when opportunities come, you must invest, right? So you need to ask yourself some questions. Are you letting the headlines dictate your investment strategy? Do you have a list of vetted sponsors looking to take advantage of the next cycle? Are you filling out the market, constantly staying in tune with what's going on? And then are you going to be ready to invest when the time comes? Really, really important. Again, nobody on this webinar today wants to miss out on the next opportunity to invest into a project at a massive discount. Well, if you're not preparing yourself, both your capital and your cash, and then your mindset to invest by following all the data that we talked about today, regardless of what the headlines are saying, if you're not preparing your mindset to take advantage of the opportunity, you're going to get scared. You're going to get nervous. You're never going to invest, and you're always going to have an excuse of why you shouldn't invest. When prices are low and everything's on a discount and the headlines are saying real estate is terrible, you're going to be scared to invest. When prices are high and it's really hard to get a deal done and there's no cash flow, you're not going to want to invest because there's no cash flow. There's no win-win. There's never a sweet spot in the middle. You have to take the leap. You have to take the opportunity when it presents itself, and you have to be ready. And the best way you can do that is just by following the data, getting educated on the asset class that you're interested in, and then finding a trusted partner like Headway Capital. So real quick, just want to cover a couple of things for Headway. These are the opportunities we present our investors to. We love apartments. We talked about multifamily today a lot. We also have service businesses that we look at such as car washes. I'm really bullish on those as well. We launched a car wash a few months ago. We just paid our first distributions to our investors this past month, so they're very happy. They got their first distribution, and we're going to continue to look for car wash opportunities in the Texas market. And then we also have our hard money debt fund. So if you're looking for cash flow and you want monthly dividends, then this is a great investment opportunity for you. This is a cash flow play. So if you have $100,000 sitting around and you're looking for a place to diversify outside of the stock market, outside of high yield savings or outside of CDs, the debt fund is a great opportunity for you to look into. It has a 90-day liquidity window, so you don't lock your money up for long term like a lot of our projects do. And it pays an 8% return for $100,000 that are invested. There is a smaller min, so if you're looking to invest less than $100,000, please reach out to us. We can talk more about the returns that come with that. But for the 8% return, it does require a $100,000 minimum investment. There's no upside here. There's no tax benefits as you would get in like the multifamily or the car wash deals. This is strictly for an investor who's looking for steady yield, steady cash flow, and wants to park some extra capital into this fund. So please scan the QR code if you're interested. If you like what you heard today, and we're going to do some Q&A here in a second. I got lots of questions coming in. Please sign up to join our private investor club. So when you complete an application, you're going to request an invite to join our club, but you're going to need to schedule a call with me or Sid or somebody on our investor success team, Daniela, and just get qualified. Make sure these are the right opportunities for you. Make sure that you're the right type of investor for us. You can schedule a call if you'd like to discuss first, or you can just fill out this form by scanning the QR code on the right side. And it's going to take you to a quick form to fill out. And once you fill that form out, we'll reach out to you via text and phone and email as well, just to get you on our schedule and just have a quick 15 or 20-minute conversation to get you qualified so that you can join our private investor list, so that when we actually have investment opportunities, whether they be in multifamily, car washes, or other asset classes, you can actually participate in them and you don't miss out. Again, if you're not on our private investor list, you're going to miss out. We talked about not missing out on the next deal. You got to get on the investor list, right? You got to join the investor club. It's free of charge, but you do have to get qualified. I want to make sure that everyone we work with understands what we're investing in. They're qualified to invest and they are accredited. Now, we only work with accredited investors. So that's anybody who has $1 million net worth or makes at least $200,000 a year if single, or $300,000 a year if married, and has 2 out of the last 3 years, and plans on doing the same going forward. So please reach out to us if you're interested. Let's jump into some Q&A. I did see some questions come in. Let me pull up this Q&A box. If you have any questions, please put them in the Q&A box. I'm going to run through these. Do you think the Fed raises interest rates in September? People are asking me to reach into my crystal ball here. So the question again, let me repeat it. Do you think the Fed raises interest rates in September? I'm going to go with no. And the reason being is the data. I think I last looked, there was less than a 20% chance that the Fed raises interest rates in September. I think it might have actually dropped even further. There's a really low chance. And part of the reason people are very optimistic, I should say, that the Fed is not going to raise interest rates in September is the job data that's coming out. So not only are we seeing a decrease or deceleration in inflation, we are also seeing jobs being cut, right? We're not seeing the same job market strength that the Fed has been really barking about how resilient the job market is. We only saw 187,000 jobs reported for last month. And I guarantee you, when they revise that number, which they always do very quietly without telling anyone, every month the number gets revised. I bet you that 187,000 is not that high. It's probably, I don't know, I'm pulling out my crystal ball here. It's probably around 130 to 150, right? So the jobs have fallen off a cliff, and there's other data out there if you do your research showing that most of the jobs that are available are actually part-time jobs, which is not good either. There's more part-time jobs out there, or an equal amount versus full-time. That's not what you want to see in a strong job market. So the labor market is softening, and that gives me optimism that they are not going to raise interest rates in September. I personally think they're done, unless the data comes back and shows them that inflation has taken off. We saw that in the 1980s, where the Fed aggressively raised interest rates, or 1970s, late 1970s, early 80s. They aggressively raised interest rates. They backed off too soon. They cut rates too soon, and inflation took off again. I don't think they're going to make that same mistake twice. I think they're going to keep them higher for longer. I don't think they're going to keep raising rates, but what I think they're going to do is they're going to keep them high for longer. And then they're going to come out of nowhere and they're going to unexpectedly cut rates. They're not going to warn you. They're not going to say, hey guys, next month we're cutting rates. No, they're just going to randomly, unexpectedly cut rates very slowly. They might go 25 to 50 basis points, just like they've been slowly raising it up over the last few months. They'll do a slow cut and slowly work their way back down. So that's my crystal ball. I could be totally wrong. Don't quote me on that, but I think we're done raising rates. Personally, I think we're going to take a wait and see approach unless the data comes out negative. What would cause the Fed to pause or lower interest rates? I kind of just hit on that. That's a great question as well. Job data is a big reason to pause or lower interest rates. And then also, one of the things we didn't really touch on today is some of the weak economic data that's coming in. One of the things we didn't touch on today is what's going on in China. China is having a really bad credit crunch, I should say. There's a lot of data coming out about big commercial real estate, private equity, big billion-dollar companies that are filing for bankruptcy. And the government is having to step in and save the day, so to speak. Well, that's going to have an impact on the U.S. economy as well. And some of those cracks in the armor could start to chip and could cause the Fed to need to put some sort of policy in place to soften the blow, so to speak. Otherwise, we're going to have a hard landing, and we won't have that soft landing that they've been talking about. So we shall see what happens with the interest rates. Have you begun to see a lot of discounted properties in the market yet? Oh, that's another good question. Yes and no. I will say we have started hearing rumblings of discounted properties. We are starting to receive calls from brokers that we have done business with in the past, and we are starting to hear that there are opportunities and there are distressed sellers out there. Some of them are smaller sellers that nobody would know of if I mentioned their name, and some are actually bigger names that are in a position where they have some assets they need to sell. Well, part of the reason is as I mentioned, they overpaid in 2021. They've got floating rate debt. They don't have fixed rate debt. They used a bridge loan, and they did or didn't buy a cap. Either way, they're not cash flowing like they thought they would, and they need to sell. Right? They're getting to a point where they need to sell before they their loan expires, because these floating rate loans are what are called 2-1-1-1s or 3-1-1s, meaning they're only 2 or 3 years, and you have to qualify to get the extensions. Well, guess what? The rent growth has slowed, and a lot of properties are having problems when it comes to operations or delinquency, because some residents are struggling to pay rent in some of these lower quality assets, and they need to sell. Well, there's going to be an opportunity for us to come in and save the day, so to speak. And I think those are coming, right? And I think people that maybe have been sitting on the sidelines, they don't need to sell. They're not motivated, like they have a bad problem, but they just want to sell. They've held their properties for a long time. They've had them 5, 6, 7 years. They're ready to sell. They missed 2021, and now is the next best time. Well, they're going to come to market pretty soon when things sort of stabilize, the volatility stabilize, and I think there's going to be some buying opportunities here in the future. But we have started to see some discounted properties, but nothing that gets us super excited quite yet. But I think those are right around the corner. If I were to invest in a deal now, would it cash flow? That's a great question. Again, yes. Well, let me say this: if you invest in a deal with Headway, we really, really, really only like presenting investment opportunities to our investors that cash flow. Just because it's too risky to invest in something that doesn't cash flow unless that's part of the play, right? If you're buying land or you're doing new construction, ground up development, then that is going to be a non-cash flow play, right? Much different than doing a multifamily deal. So if we present you with an opportunity, it's because it has a cash flow play to it. It might not be day one, but maybe it's, after 90 days or after 180 days. Once we get the property stabilized, we want to make sure we're seeing cash flow year one. That's really, really important to us. I personally right now would not touch anything that didn't cash flow. I think it's too risky based on what's going on in the market. That cash flow to me is an insurance policy. So that's just my piece of advice. Last question I see coming in, please feel free to drop any more. Last question I see in here is, how do you hedge against rising interest rates? I think what they're asking here is, how do we at Headway hedge against rising interest rates? Well, there's a few strategies here. So one, if we buy a property, let's say we go put a property under contract tomorrow, we find this great deal, we want to put it under contract tomorrow. There's a couple of things we can do to hedge against interest rates. One, we can buy fixed rate debt, right? We can use fixed rate debt just like you would with your house. If you were to buy a house tomorrow, you would go get a 30-year or 15-year mortgage. It would be fixed rate, and whatever rate you're paying when you sign that document is what you're paying for the remainder of the loan. Obviously, you can refinance, but that's a new loan. That's not the existing loan. So we can buy fixed rate debt for our investment properties as well. Now, they're not 30 years, right? They're much shorter than that, typically 10 or less, but they're still fixed rate, right? And they probably come with some sort of IO period, which is considered interest only. So we can buy fixed rate debt, and that's a hedge against interest rates going up, right? Now, there's a downside to that. If you buy something with fixed rate debt and interest rates drop, well, now you're stuck in a loan that has a high interest rate. So let's say you invest in a deal today, and the interest rate, just make up numbers here, let's say the interest rate's 6%. Well, let's just say it's a 5-year hold, and at the end of year 3 or at the end of year 4, the Fed has begun cutting interest rates for several months now, and now that 6% fixed rate debt, it looks very expensive because rates are at 4.5% or 4.25% or 4%. So now you're stuck in a loan that's 150 to 200 basis points higher than what the market is dictating now. That's not necessarily a bad thing, but if you try to sell the deal, you could have a hefty prepay penalty for selling the loan before the term is up. In a low interest rate environment. So the lower the interest rates drop, the higher your prepay is, which is again a bad thing. You could leave millions of dollars on the table. Now that's just one scenario. The other option is to actually buy with floating rate debt, which isn't a bad thing either. It's just another opportunity, another option. And you buy with floating rate debt, but you buy what's called an interest rate cap. So an interest rate cap is a product that you can stack on top of your loan that prevents the interest rate from going past a certain number after closing, right? So again, let's just speak hypothetically here, keep it really simple. Let's say you close today and you have a 6% all-in interest rate and you buy a 1% cap. Well, you've got a 1% cap, meaning that the strike can't go above it. So your interest rate, again, just speaking hypothetically to keep it simple, can't go above, say, 7%. As long as your model, your underwriting, your Excel spreadsheet, all the data on the formulas you've calculated show that your property still makes money, it still cash flows, you won't lose it at a 7% interest rate. Well, that's a safe investment, right? Because even if interest rates go up, you've hedged against that interest rate by buying an interest rate cap on top of your original loan, right? Now, these interest rate caps, they're very expensive right now. during during the last 12 to 18 months, because of the volatility, which is a big part of how interest rate caps are actually priced, they've actually gotten really high. There are some interest rate caps that are $1 million or more, or were, I should say. And now they've gotten to the point where they're still in the hundreds of thousands range, right? You can still pay $500,000 for an interest rate cap. So you'll go and you buy a loan and you have to pay an extra three, four, five, six, $700,000 for an interest rate cap. Now that's the cost of doing business. So still doable, but it is an extra expense that we have to account for if we're buying a property and plan on using floating rate debt. So again, I got pretty detailed there, but that's the best way to hedge against rising interest rates is buying at the right price and using the right loan product, making sure your deal cash flows from day one, making sure you're using the right loan product, whether it's a fixed rate loan or a floating rate loan. There's no right or wrong. You want to use the right product for the right deal. You want to make sure it cash flows. And you want to make sure you're not exposed to any interest rate volatility any more than you have to, just so you can protect your investors. Don't see any more questions in the Q&A box. So if you have any, please drop them in now. I just want to thank everyone for hopping on this session of Legacy Wednesday. We bring you this session every Wednesday so you can be a smarter investor. You can stay in tune with what's going on in the market, and you could build trust and confidence in Headway Capital and that we are the right investment firm for you. So if you have any interest in reaching out to us, please, this is my email address here on the screen. You can also scan one of the previous QR codes to apply or schedule a call. But we appreciate everyone joining us today. We hope you have a good rest of your day. Take care.